I have a secret that Wall Street hates. It is a secret that the financial media will never tell you, because if they did, they would go out of business. The secret is this: in the world of investing, effort does not equal results. In fact, in 2026, effort is often inversely correlated with results. The hardest working investors I know, the ones who watch 6 screens, trade 50 times a day, read every headline, and try to time every dip, are usually the ones who underperform the market. They are running on a treadmill, sweating, stressing, and paying fees, only to finish behind the person who bought a good asset and went to sleep for 10 years. We are entering an economic environment in 2026 where trying to be smart is going to be very expensive. The market is becoming increasingly volatile. Algorithms are becoming faster. Artificial intelligence is making short-term trading a battlefield where you were bringing a knife to a nuclear war. You cannot out-trade the machines. You cannot out-hustle the high-frequency algorithms. But you can beat them. You can beat them by playing a game they cannot play. You can beat them by being lazy. I have often said that my style of investing is lethargy bordering on sloth. People think I'm joking. I am dead serious. The money is not made in the buying and the selling. The money is made in the waiting. Today, I want to teach you the art of lazy investing. This is not about being lazy in your life or your career. It is about being strategically inactive with your capital. It is about setting up a system that protects you from your own desire to do something. In a world that glorifies the grind, I am here to tell you that the grind destroys wealth. The sit builds it. Here is how to position yourself as the ultimate lazy investor in 2026 and why this approach is the only one that survives the chaos ahead. The math of inactivity. First, you must understand why laziness works. It comes down to 3 silent killers of wealth: fees, taxes, and mistakes. Every time you try to be smart, every time you sell a stock to buy a different one, or try to time the top, or try to hedge a position, you trigger a taxable event. You pay a spread, you pay a commission, you create friction. If you trade your portfolio once a year, you are giving away a portion of your return to the government and the broker. If you trade it once a month, you are working for them. But the biggest cost is the mistake tax. Human beings are wired to buy high and sell low. It is biological. When the market crashes in 2026, and it will have moments of panic, your brain will scream at you to do something. That something is almost always selling at the bottom. The lazy investor has a system that prevents this. They have handcuffed themselves to the roller coaster. They might feel sick, but they don't fall out. Here are the 5 rules of the lazy investor that will make you richer than the smartest trader you know.
Rule 1. The too hard pile. Most investors lose money because they try to solve difficult problems. They try to predict the future of a biotech company. They try to guess which crypto coin will survive regulation. They try to time interest rate cuts. These are hard problems. I don't solve hard problems. I have a box on my desk labeled Too Hard. 99% of investment ideas go into that box. I only look for 1-foot bars. I don't want to jump over 7-foot bars. I want to step over 1-foot bars. In 2026, the economy is confusing. There are wars, debts, AI disruptions. Predicting the winner of the AI wars is a 7-foot bar. It is hard. Betting that people will still buy food, use electricity, and need insurance in 10 years? That is a 1-foot bar. The lazy investor ignores the complex and bets on the inevitable. Don't look for the needle in the haystack. Buy the haystack. Buy the broad index. Buy the companies that have dominated for 50 years and will dominate for 50 more. If you have to use a spreadsheet to prove it's a good investment, it's too hard. Walk away. Rule 2. The 20-slot punch card. Imagine I gave you a punch card with only 20 slots. Every time you make an investment decision, buy or sell, you punch a hole. When you hit 20 punches, you can never make another financial decision for the rest of your life. How would you behave? You wouldn't trade on a rumor. You wouldn't buy a stock because your neighbor mentioned it at a barbecue. You wouldn't sell because the news said recession coming. You would be incredibly careful. You would do deep research. You would only move when you were 100% certain. And once you bought, you would hold forever because you wouldn't want to waste a punch on selling. This is how the lazy investor thinks. They view every decision as expensive. In 2026, the market will try to bait you into using your punches. Buy this IPO, sell this sector, rotate into bonds. Don't do it. Pretend you have used 19 of your punches. Save the last one for a true crisis. For the rest of the time, sit on your hands. The person who makes 3 great decisions in a lifetime beats the person who makes 3,000 mediocre ones. Rule 3. Divorce the news. The financial news cycle is the enemy of the lazy investor. It is designed to create urgency, breaking news, market turmoil, crash imminent. If you watch this, you will feel the urge to act. You will feel that by doing nothing, you are being irresponsible. This is the money illusion again. The news sells ads. It does not sell wisdom. The lazy investor unplugs. They look at the business, not the ticker. If you own a farm and the local newspaper shouts, "Farm prices down 20% today," do you sell the farm? No. You look at the crops. Are they growing? Yes. Then who cares what the paper says? In 2026, the headlines are going to be terrifying. They will talk about debt cliffs, currency collapse, and political instability. You must build a mental firewall. If the businesses you own, via your index fund or direct holdings, are still selling products and making profits, the headlines are noise. The price is irrelevant. The value is the crop. Rule 4. Automate the drudgery. Laziness requires preparation. You can only be lazy if you have built a machine that works for you. You cannot rely on willpower to save money. You cannot rely on memory to pay bills. The lazy investor automates everything. Auto-invest. The day the paycheck hits, the money moves to the brokerage and buys the index. No decision made, no chart checked. Auto bill pay. No late fees, no stress. Dividend reinvestment. DRIP. When a company pays you, that money instantly buys more shares. The compound loop is closed automatically. By automating, you remove the behavioral gap. You remove the chance for you to mess it up. You set the course once, and then you go play golf, or read a book, or spend time with your grandchildren. The machine is working. Let it work.
Rule 5. The forever horizon. The ultimate hack for laziness is to change your time horizon. If you are investing for next week, you have to work very hard. You have to watch the screen every minute. If you are investing for 20 years from now, you can afford to be completely checked out. In 2026, we are seeing a compression of time horizons. People want to get rich in 24 hours. They are trading 0 DTE options, 0 days to expiration. This is not investing. This is playing Russian roulette with a fully loaded gun. The lazy investor looks at a stock and asks, would I be happy to own this if the market closed down for 5 years? If the answer is no, don't buy it. If you buy assets that you are terrified to hold, you are renting, not owning. Renting requires maintenance. Ownership requires patience. The lazy portfolio for 2026. So what does this look like in practice? If you want to be the lazy investor who survives the 2026 volatility, what do you buy? You buy the American tailwind. Despite all the problems, despite the politics, despite the debt, the American economy is still the most robust engine of wealth creation in history. A low-cost S&P 500 index fund is the ultimate lazy investment. You don't pick the winning companies. The index does that for you. It automatically adds the winners and drops the losers. You don't pay high fees. You don't have to read balance sheets. You don't have to watch the news. You are betting that 500 of the smartest, most aggressive CEOs in the world will wake up every morning and try to make money for you. That is a bet I will take every time. And for the sleep well at night portion of your portfolio, short-term U.S. Treasuries. Cash. It pays you interest, it doesn't fluctuate, and it is there if you ever need it. 90% S&P 500, 10% cash/bonds. or adjust based on your age. That takes 5 minutes to set up, and it beats 90% of the hedge funds that charge you millions to manage risk. In 2026, you are going to feel a lot of pressure to be smart. Your brother-in-law will tell you about a new AI stock. Your taxi driver will tell you about a crypto coin. The news will tell you to sell everything and buy gold. The pressure to act will be immense. I want you to resist it. I want you to embrace the power of doing nothing. When you feel the urge to trade, go for a walk. When you feel the panic rising, read a history book. When you feel the greed kicking in, look at the too hard pile. Wealth is not a prize for the busiest. It is a reward for the most disciplined. The tortoise beats the hare, not because he's faster, but because he doesn't stop and he doesn't get distracted. Be the tortoise. Be lazy. Let the miracle of compounding happen without your interference. Your future self will not thank you for the hours you spent staring at a screen. They will thank you for the decades you spent staying the course. Subscribe to this channel. We are going to keep preaching the gospel of simplicity. We are going to keep you focused on the signal, not the noise. Sit down, relax, and get rich.